This video is called Is Passive Indexing Smart? There's been so much attention to this topic lately, most overwhelmingly in favor of passive investing. So we'll walk you through it and show you what we think. We'll first clarify what passive investing means, then explain why it works, show the drawbacks, and finish with some recommendations. Passive indexing is not totally passive. The index changes from time to time according to changes in its constituent cap weights. New growing companies enter the index and old laggards are removed, which requires rebalancing. So it's not entirely passive in the sense of buy and hold. What is truly passive is buying and holding the same stocks. That is the only true passive strategy. That's sort of what Warren Buffett does. He buys companies and he holds them. Buffett has said that he wouldn't care if the market closed down for 5 years because he buys companies for their earnings and dividends and is not interested in the day-to-day movements of the stock price. And that is actually a good passive litmus test, which is if the market needs to be open to implement your strategy, then it is not passive. However, for the purposes of this video, we're going to go back to talking about passive indexing because that is what most people refer to as passive investing. So what does passive investing in, say, the S&P 500 represent? Basically, the passive index represents the aggregate performance of all active managers gross of fees. And so you have all these active managers running around buying and selling stocks, and all that activity results in establishing prices for each of the components of the index. So the index is really just a scorecard based on how the active managers decide on how much to pay for different companies. Now, in aggregate, after fees, taxes, and commissions that active managers charge, it is theoretically impossible for all active managers to beat the index. That is because they are the average gross of fees, but after fees, they cannot match the gross performance before fees. And so that is actually why passive indexing is a smart strategy, and John Bogle of Vanguard recognized this a long time ago because it is basically a free ride on the collective intelligence of all the active managers. So you get to access the collective intelligence of all active managers without paying anything essentially because passive indexing has become so cheap. It's essentially free. You can get into an S&P fund for less than 10 basis points per year. The biggest drawback of passive investing is that you get to participate in the drawdowns, which can be quite large from time to time. The average drawdowns from the peaks are 20 to 25%, and extreme drawdowns can be 40% plus. So you have to be prepared to sit through those drawdowns. The evidence shows that very few active managers beat their benchmark consistently over a long period, say every year for 10 years. And even the few that have, even that could be attributed to luck. For example, if 10,000 people flip a coin 10 times, you will get perhaps 30 that get 10 heads in a row just by luck. So in the same sense, with managers, that outperformance could be due just to luck. And the second problem is that there is an additional layer of probability risk because you still have to be able to pick the manager that will outperform. So two levels of uncertainty there. So the key takeaways from our perspective is that unless you have discovered a strategy that generates high alpha with less risk, given the costs of active management and the low likelihood of outperformance, passive indexing is a reasonable approach. However, given the potential for large drawdowns, you should diversify asset classes and rebalance frequently, which can help to smooth out the returns. So that's it for passive investing. Thanks.